Welcome back to The Global Anchor, the podcast that explores the biggest decisions shaping the world economy. I'm your host, Alex, and today we're diving deep into an extraordinary monetary experiment that stabilized a nation but came with a monumental cost: the dollarization of Ecuador.
And Alex, I'm thrilled to be here. This isn't just a history lesson. It's a profound case study in what happens when a country trades monetary sovereignty for basic stability. Ecuador's journey from the brink of hyperinflation to the calm of the US dollar is truly unique.
Exactly. Our guest today is Dr. Maya Singh, a financial economist specializing in emerging markets and currency systems. Maya, thank you for joining us.
My pleasure, Alex.
So let's set the context. Many of our listeners understand inflation in terms of current events. But what was the reality like in Ecuador in the late 1990s? Why did the government ultimately choose the US dollar?
You have to paint a picture of total financial collapse. Imagine earning your salary, depositing it in the bank, and realizing that within 30 days, that money has lost 20% of its purchasing power. That was the experience of the Sucre, the national currency. It was being devoured by hyperinflation, which hit nearly 100% in 2000, alongside a devastating banking crisis.
A banking crisis that included the infamous banking holiday, right?
Absolutely. In March 1999, the government, in a desperate move to stop capital flight, froze citizens' deposits for several months. That single event didn't just hurt finances. It utterly destroyed public trust in the banks and, more critically, in the currency itself. When people lose faith in their money, they spontaneously start seeking refuge in hard assets. And in Ecuador, that asset was the US dollar.
So the government's formal decision on January 9th, 2000 to fix the exchange rate at 25,000 sucres per dollar and adopt the greenback, it was less of a policy choice and more of a formal recognition of reality.
Precisely. We call it an emergency release valve. The economy was already spontaneously dollarized. Businesses were transacting in dollars, and people were saving in dollars. The government simply formalized what the citizenry had already decreed just to survive. It was a major economic surgery to stop a hemorrhage.
Let's move to the core discussion, the advantages. Dollarization is a radical step. You give up your own currency. What did Ecuador gain in return for that massive sacrifice of monetary sovereignty?
The single non-negotiable gain was stability. It's a very precious commodity. The biggest win was the elimination of chronic high inflation. Think of it this way. A dollarized country loses the key to the money printing machine.
That's a powerful analogy.
It is. A traditional government can finance its deficits by printing money, which is essentially an inflationary tax on its citizens. Ecuador lost that tool, which forced a degree of fiscal discipline. Inflation, which was near 100%, quickly dropped to single digits and has stayed remarkably stable, largely matching U.S. rates.
And for investors, that stability must look like gold.
Pure gold. It eliminates exchange rate risk. If I'm a transnational company, I don't have to worry about the Ecuadorian government suddenly devaluing the Sucre by 30% overnight. That predictability compresses the country's risk premium. Lower risk means lower interest rates, which makes credit cheaper for everyone, businesses and families alike.
So dollarization acts like a monetary thermostat, anchoring the entire economy to the most stable monetary system in the world, regardless of how chaotic Quito's internal politics get.
That's the perfect metaphor. The most immediate beneficiaries were the wage earners and pensioners, whose purchasing power was finally shielded from that daily inflationary erosion. For them, stability wasn't an abstract concept. It was the ability to plan their next month's budget.
That brings us to the downsides, because this is where the conversation gets difficult. If stability is the reward, what is the cost of monetary sovereignty?
The cost is rigidity. It's like a Formula One car driver who gave up power steering and traction control. They can go extremely fast on the straightaway, but when a dangerous curve comes, an external crisis, they have to be infinitely more precise.
Specifically, what tools did the central bank lose?
Two critical tools. First, the lender of last resort function. If a major bank faces a run, a traditional central bank can inject unlimited liquidity, print the necessary funds to stop the panic. Ecuador cannot print dollars. They must use existing reserves, which makes the financial system structurally more vulnerable.
That's a serious vulnerability. And the second tool?
Exchange rate policy. Normally, if a country's exports become too expensive, the government can devalue the local currency, making those exports instantly cheaper globally. Ecuador lost that lever. If the cost of production rises, the only way to regain competitiveness is through an internal devaluation, cutting wages, cutting costs, which is socially and politically painful.
That means when there's an external shock, say a drop in the global oil price, which is a huge revenue driver for Ecuador, the adjustment isn't absorbed by inflation, but by unemployment and recession.
Exactly. That rigidity translates directly into persistent high employment or underemployment, a real challenge the country has faced. The monetary policy, interest rates, everything is dictated by the U.S. Federal Reserve in Washington, not by local needs in Quito.
Let's pivot to the human element. The immediate social cost was enormous. The announced conversion rate basically pulverized the savings of thousands of people.
It did, and that devastation led to one of the largest migrational waves in Ecuador's modern history. Hundreds of thousands moved to Spain, Italy, and the U.S. It's a tragic story. But here's the irony. That mass migration eventually became a major stabilizing factor.
Because of remittances.
Precisely. Remittances are a constant, a massive inflow of fresh dollars. If your family member abroad sends you $500, that is worth exactly $500 year after year. In the old Sucre system, that $500 could lose half its value by the time it hit the bank. Dollarization maximized the impact of those remittances, providing crucial stability to thousands of households.
That's a powerful example of a personal tragedy unintentionally solving a macroeconomic problem. Maya, what are the emotional or psychological insights here? How did this change how Ecuadorians view money?
The deep psychological insight is that trust is the most valuable asset in any economy. The 99 crisis was a monumental betrayal. Therefore, dollarization became the emotional safeguard against political mismanagement and corruption. For the average person, stability, the preservation of their labor's value, is the highest priority, far outweighing the abstract concept of monetary sovereignty. They prefer a wage that holds its value, full stop.
That makes sense. Let's finish with some practical application for our listeners. What actionable tips or lessons can an investor or entrepreneur outside of Ecuador take from this case study?
There are three main takeaways. First, the discipline lesson. Ecuador gave up the easy money of printing for the strict fiscal discipline of the dollar. The lesson for personal finance is prioritize assets that protect your capital from inflation. Don't rely on easy money or unsustainable debt.
Discipline equals stability. Got it?
Second, diversification. The rigidity of dollarization means external shocks hit hard. This forces the country to focus on structural reforms and economic diversification. For an entrepreneur, this means your sustainable growth must come from real productivity and expertise in tech, tourism, agribusiness, not from relying on a cheap, devalued currency to compete.
Don't chase currency arbitrage, chase efficiency.
Exactly. And the final tip, never underestimate the non-reversibility of big decisions once confidence is involved. Dollarization is so popular, it's viewed as the economy's seatbelt, that attempting to undo it would be a political and economic catastrophe. Once you anchor your system to trust, pulling that anchor up is nearly impossible.
That's fascinating. The citizens' vote of confidence is the ultimate policy lock. Dr. Maya is saying this has been an incredibly insightful conversation, detailing not just the economic mechanics, but the human cost and the eventual reward of this massive choice. Thank you for sharing your expertise.
Thank you for having me, Alex. It's a story that truly reminds us that difficult financial decisions are often the most necessary ones.
And to our listeners, if you're looking to protect your wealth or understand fixed exchange rates, Ecuador's journey is your textbook. We encourage you to reflect on whether the fiscal discipline imposed by an external currency is the only way to guarantee long-term stability in volatile environments. You can find links to Maya's work and related articles on the Fed and inflation in our show notes. Until next time, stay anchored.